Gold and silver, best performing asset class in 2022. So let's have a sneak peek into the chart book of the In Gold We Trust report in 2022, which I think comes out in May. So the first chart we'll have a look at, are 4 decades of disinflation now over? Well, this whole talk about disinflation, right? And a lot of the deflationists, talk about it a lot. And, so they say sit in cash, disinflation, sit in cash. Well, this is what disinflation looks like. It's still, from 2020, we're still looking at almost a 50%, cost in your purchasing power. 44.2% increase in inflation since 2000. This is what low disinflation looks like. It still eats at your purchasing power. Now, a lot of people will point to velocity. Jim Rickards talks about velocity. Whole heap of rubbish, really. It really is. When you actually look into when you do the calculations, it's rubbish. Back in 1946, we had similar levels to velocity, yet CPI was over 19%. In the 70s, we had relatively low velocity, yet we had high CPI. And in the 90s, look at that. In the 90s, we had high velocity, yet we had low CPI, aka disinflation. Yeah, and I like this chart as well. The persistent myth that stocks protect against inflation. And you can see for that 1970s period, the Wilshire 5000 went sideways. And when measured in real terms, it wasn't good at all. It's interesting. I've done many videos. My base case still today is for a 1973-74 style recession, where we see the stock market or asset prices fall 50% nominal terms. Now, I don't have a price target as to where asset prices will fall this time around, but they fell 50% nominal terms during that time when we had CPI at 12.5%, and from memory, interest rates were around the 8% mark. So we had negative real rates, but we had asset prices going down, and we had a recession. And I think we're still going to have high CPI. And as central banks raise rates, we're going to see asset prices come down. How much? That's the big question. So here, inflation rates shoot up with the peak is yet to come. Some analysts say that the peak will come towards the end of this year. I've always said things don't go up in a straight line. That if you look at whether it's the 1940s or even the 1970s, CPI goes up, CPI comes down, CPI goes up, CPI comes down, and I expect something similar as well. So I just had to share this chart from one of my all-time favorite economists, Austrian economist Eugene von Bombarwerk. Political power can never override economic law. So this was an interesting chart. Historically, M2 growth was only faster in the 40s and the 70s. And, well, you guys know what happened with CPI in both the 40s and 70s. And the Buffett indicator hits new all-time high. The stock market cap reaching approximately 200% of US GDP. Oh, man, we really have financialized our economy, haven't we? So who's wrong? The US dollar or commodities? I found this chart very interesting. I actually have never seen this chart before. So we're seeing a divergence here when we look at the Dixie inverted against the commodity index excluding energy. Who's wrong? Which one's wrong? I'll let you guys work that one out. And so if we're we're already in a stagflationary environment. What am I talking about? which asset classes work in a stagflationary environment. When we look at the different asset classes, average nominal return, look at gold and silver, 38.7 and 26.9%. Average real return, 24.9 and 13.1. Obviously, oil is good there too. And what have we seen oil from its bottoms in 2020? Now, you guys know that I bought into coal in particular, rode that up, sold that, moved into the oil sector, and to be honest, I've now taken some profits off the table because my oil positions have done exceptionally well in a much shorter period of time than I expected. So oil and energy is a good one as well, but gold and silver, I still think that's where most investors should be. In fact, when we look at the Q1 2022 performances of asset classes, we can see that commodities and gold outperformed. So, I mean, it's right there. So it really is a question of perspective. Are we seeing rising gold prices or declining purchasing power of fiat currencies? That's really the question in terms of perspective there. And this is another big question. Despite the recent decline in debt to GDP ratio, it is unlikely that this movement will manifest as a long-term trend. When we get to this kind of level of debt to GDP, what do? Do you default on the debt in nominal terms to get that debt to GDP ratio down? Or do you inflate away the debt and reduce that debt to GDP? Luke Groman and Jim Rickards will argue that the quickest way to do it is just to simply revalue gold. And you can reduce your debt to GDP that way. Either or. I think we could see a little bit of both, actually. What happens when US equity wealth gets cut in half? We've got value of equities held by US households and non-profits, and then also as a percentage of GDP. And wow, hasn't the last 2 years been crazy? Absolutely crazy. And yeah, wow, it's got a long way to fall if it's to fall back towards its mean or its trend. So I found this also quite interesting. When the Federal Reserve stops hiking and stocks go down, recession tends to be near. Now, we've seen yields invert, and that has a very successful rate in predicting recessions about 18 months in advance. So I guess what that tells me is they're predicting that central banks will raise rates, which will then see asset prices go down. We'll probably see some debt defaults, and then the central banks will stop hiking, and then we'll have a recession. So look, some people think, some analysts say that we'll see central banks hike rates, but as soon as asset prices start to tumble, they'll stop, turn around and begin quantitative easing again, reducing interest rates and so forth. And I think that's my base case. However, other analysts argue from a political point of view that inflation is now becoming such a political issue for voters that central banks have got absolute permission to raise rates and to kill inflation, to kill CPI. And, that certainly makes sense as well. And they argue that, it's the lower and middle class that feel inflation the most. And they also hold the least amount of financial assets. So if financial assets fall, well, it's the big end of town, so to speak, that get crushed, get hurt. So there's this political aspect to it as well. And so I don't think you should be an absolutist one way or another. I think you should be prepared for either scenario to play out. So a deflationary mindset still dominant. People are expecting prices to drop, which is the highest reading since March 1982. Now, I'm not sure if this is asset prices or actually goods and services, because like I said, I still think my base case is 1973-74, where we see asset prices fall, but CPI at 12.5%. So I think we see goods and services continue to increase. So our purchasing power for goods and services continues to go down, while asset prices may come down. In fact, I think they will. Now, looking at gold, Martin Pring. History shows that equities are at their most vulnerable when being outperformed by the yellow metal. Well, I showed a chart earlier in first quarter, commodities and gold are outperforming all other asset classes. So it also depends what currency that you're in as well. 2021 wasn't a fantastic year for gold. So far, as I said, 2022 is started off very well. And once again, gold proves its safe haven quality. As so far, it's up in every different currency. But if you have a look over the last 22 years, whether you look at an individual currency or the average, gold's had 3 red years in that time. 3 red years. And this is why, for me anyway, holding a percent of my portfolio in gold is vital. And in fact, Chris Cole, through his Dragon portfolio, proves that the best performing portfolio back tested over a 100-year period. So going through both inflationary and deflationary times, the best portfolio has gold in it. So I think for me anyway, holding gold is vital. And this was pretty cool. So the world gold price reached an all-time high in 2022, not in US dollars though. And this chart, so gold demand of institutional investors is still dormant. As I said though, the Bank of America survey they do to investors whether they believe inflation is transitory or permanent. We got to go back, I think it was August last year, that 70% of investors believed the Fed and other central banks talked that inflation was transitory. And so why would you want to hold gold if you think that inflation is transitory? From an institutional investor point of view, you're better off being in risk on assets. However, we have seen a change. So, look, I think there is, and even looking at these charts, there is a slight little tick up. Okay, and we have seen institutional investors, well, I have heard it directly from some, that they have moved out of risk on assets and that they are looking at risk off assets like gold. So, when they really do start to pour in, you'll also see less shenanigans going on with the bullion banks. So this is a really, really interesting chart, and I've shared similar charts in the past when we look at the S&P 500 versus gold during times of equity crashes. So you look at the S&P 500 return, all the crashes that have happened, and then look at the gold return. Now, gold doesn't always go up in a equity market crash. You can see that actually, on 5 occasions, gold actually went down. However, relative, and this is what I keep talking about, don't measure gold and silver in terms of US dollars or in terms of fiat. Measure it versus other assets. whether it's real estate or stocks. And I've shared a video, Wealth Cycles. I share my story, how I turned fiat currency into silver, then into a whole heap of real estate, and then I've been selling that real estate and converting it back into gold and silver. And so you can see the chart. It's very clear, very, very clear. So I am expecting asset prices, risk on assets like stocks, real estate, bonds, to fall in value quite significantly. And I believe versus gold and silver, but versus gold, we're going to see an increase in our purchasing power against those assets. So that's why I'm positioned the way I am. So while domestic stock indices are stumbling, gold is experiencing an upswing, gold and local currency. And I mean, look at Russia. Stock market down 35%, gold up 46%. That says it all, really. So here, gold price to fully back monetary base in US dollars. Incrementum, say we're looking at $23,500. However, either in my next video or the one after that, I'm going to share with you guys a chart from Brent Johnson from Santiago Capital, which is very, very interesting when looking at if we were to fully back our monetary base by gold. I can tell you it's much, much higher than $23,500. When we look at gold miners, frankly, I think gold miners are probably more undervalued than the actual gold itself, the physical metal itself. I think gold miners are extremely attractive right now, especially the gold miners that I've been investing in anyway. So miners are starting to outperform gold, but still historically cheap. And I've shared charts before that show the miners really give you the leverage over the underlying asset, which is gold. And let's just finish off with a couple of silver charts. Rich Ross says trading silver is a tough way to make an easy living. So you can see, just like gold, silver is trading higher in all major currencies year to date in 2022. So silver's done quite well in the first quarter. Now, from this chart, you compare this one to the gold chart, you can see that silver is a lot more volatile than gold. Gold, like I said, I want to hold, for me anyway, I want to hold gold as a percentage of my portfolio all the time. It's an all-weather asset class for mine. Silver, on the other hand, I trade silver. I buy silver, I sell silver. I buy silver, I sell silver. I've done videos on this. Bought silver in 2008, 2009, sold in 2011. Fantastic trade. Moved it into US property, and so forth. and I've shared that since 2018, I've been buying back into both gold and silver, or buying a lot more gold. I never sold my gold, but just buying more gold, buying more silver. And then in March 2020, when silver really crashed down, and I shared this at the time with many people, I was solely buying silver. I'd stopped buying gold at that point, and all I was buying was silver. And so from my March lows where I bought in, my silver position is still doing extremely well. So unlike gold, silver has not hit an all-time high. And but silver's, like I said, it's done quite well. And I think it is ripe for a very sharp move upward. In fact, later this week, I'll probably do another video where I'll share some technical analysis that shows that if we break through $30 silver, then $40 silver is going to happen very, very quickly. Very, very quickly. So, yeah, I'll share that probably later in the week. So here, silver is still trading below the median silver to S&P 500 ratio, suggesting plenty of upside potential. And yeah, I think we're going to see upside potential in both gold and silver, but also I think asset price, risk on assets are going to fall. Stocks, property, bonds, etc. And so I think while cycles, the purchasing power of gold and silver is going to buy a lot more stocks, going to buy a lot more house, going to buy a lot more bonds. I won't be going down there anyway, but you guys get it. So anyway, guys, that's a sneak peek into the In Gold We Trust report, which I believe comes out in May. Hope you enjoyed this video. I hope you enjoyed some of these charts. Love to see your thoughts and opinions in the comments below. Also, if you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance Uncut.